We'll now start with reading number 12 of the CFA curriculum that will teach us about estate planning in a global context. So we'll start by understanding the concepts of estate planning, ownership rights, mortality probabilities in core capital, relative after-tax values of various accounts, various estate planning strategies, the concepts of trusts, life insurance, and wind up by understanding taxes and the relief from double taxation. So estate essentially is everything that you own, from your house, your car, your apparels, everything that belongs to you is your estate. Estate planning is the process associated with transferring your estate efficiently, that is, with the least amount of taxes, and in an efficient manner in which you desire to leave your estate after your death. Will is the legal document that states the rights others will have to your assets at your death. This is the most common tool used to transfer assets. The person transferring the assets is known as the testator, and the probate is referred to as the legal process that takes place at death to transfer assets according to the decedent's will as determined by court. So the process of transfer is known as probate. The probate process will normally look at the will and then disseminate the assets in accordance with the will or otherwise applicable law. Due to the high costs and public nature of the probate process, individuals may sometimes take steps to transfer assets outside the probate process. That is, just before death, you may want to transfer your assets, or you may want to set up structures wherein the will doesn't necessarily need to be referred to in order to determine who the assets should go to or how the transfer will happen. So you can do this by directly transferring assets through joint ownership, living trusts, life insurance, etc., as we'll see in the coming slides. Now, when you transfer your wealth as a part of the probate process or a direct transfer, there may be various taxes that get attracted. So, wealth transfer taxes could be of the form of gift taxes, wherein gifts are subject to taxes depending on the law. Bequests, so which are basically gifts after death. So, generally speaking, gift would be referred to as a transfer while you are alive, and a bequest is a gift or is a transfer that has been done after your death. Can also at times be subject to estate taxes, which are paid either by the grantor or inheritance taxes, which are paid by the recipient of that gift. Different jurisdictions may have different requirements. So civil law is based on old Roman law, where laws are handed down by a legislative body. So it is like a top-down system. What we're trying to explain is that civil law and common law may have different jurisdictions and different say regarding how estate will be transferred and how it will be taxed. Common law is based on Old English law, where judges refine existing laws to meet particular situations. Decisions become precedents for future judgments and future decisions. So it is more a bottom-up system, that is, we take reference and then we apply to a particular situation. So not important. What's important is that different jurisdictions and different types of laws may have different rule regarding the taxation and the transfer of assets. Now, there are some ownership rights that exist in many countries and that exist regardless of other facts. For example, forced heirship entitles children to a portion of the estate regardless of what their relationship with the parents may have been. So even if the parents are estranged and don't want to leave anything for the children, children still have a right to a portion of the estate and can legally claim that estate from the parents. There are clawback provisions, that is, the children's share is often calculated after adding estate in all accounts. Particularly relevant in the case where an estranged parent transfers assets just before his death to avoid making payments under forced heirship. So if I've already transferred all assets before my death, then I don't have any assets. So even if my children claim, or even if my child claims, he can claim only what is left over. So in such a case, the value of the estate that was transferred just before death will also be added back in calculating the forced heirship and in calculating the total rights of the child or the children. So the estranged child theoretically can claw back a portion of the estate that has been transferred in anticipation of death by an estranged father or a parent. Community property rights entitle a spouse to one half of the estate earned during marriage. So normally inheritances are excluded, but whatever estate has been earned during marriage, one half is entitled to the spouse. In separate property rights, each spouse owns his or her own property, which are separate from the other. Jennifer and Steve has been married for 27 years. They have 2 married children. The community property regime under which the family lives provides that at the death of a spouse, the surviving spouse has the right to one half of the marital estate. In addition, a forced heirship rule entitles a surviving spouse to 30% of the estate, and children are entitled to split 30% of the estate. During the marriage, Steve inherited $500,000 from his parents. Marital assets which do not include Steve's inheritance, that is without the inheritance, total $1.1 million. Steve dies in a car accident and is not entitled to receive any life insurance claims. Determine the amount Jennifer would inherit under both of the forced heirship rules. So for the spouse, what the rules say is that the spouse has the right to one half of the marital estate. Marital is whatever has been earned during marriage and is separate from inheritance. So the marital assets which do not include inheritance total $1.1 million. So under the first forced heirship rule, Jennifer is entitled to one half of 1.1 million, that is $0.55 million. Another forced heirship rule entitles a surviving spouse to 30% of the total estate. So the total estate is 1.1 plus 0.5, that is $1.6 million. And the second rule entitles Jennifer to receive 30% of this, that is $0.48 million. So Jennifer would ideally receive whatever she is entitled to by the, or as the higher of the two. So she will receive $0.55 million if at all, and under the two different rules we've calculated it will be 0.55 and $0.48 million that Jennifer is entitled to. Determine the amount each child would inherit under the forced heirship rule. So the forced heirship rule entitles children to split 30% of the estate. The total estate is $1.6 million. 30% of it is 0.48 as we calculated, and there are 2 children, so the children will split 30%. Even if nothing else was left for them, they are still entitled to 0.24 million each under the forced heirship rules. So if the estater transfers all assets to somebody else, the children will be able to claw back at least 0.24 million each for themselves. Forced heirship rules in a country entitle children to split 33% of the estate of a deceased parent, subject to clawback provisions. The estate of the widowed decedent is worth $0.65 million after gifting $3 million to 3 of her children in anticipation of death. Another estranged child has now come forth to claim his legal right under the first heirship rule. Determine the amount the estranged child is entitled to under the first heirship rule. Now, the first heirship rule says that children will split 33% of the estate. So if we see the total estate, including the gift, would be $3.65 million, of which 33% would be multiplied by 0.33. And since there are 4 children, that is 3 who've received the gift and 1 estranged child who has come to forth now, then each child would be entitled to at least receive so much, which comes out to be $0.3 million. So even if this 4th child was left nothing, 3 million was gifted and 650, let's say, was given elsewhere, he could still come and claw back $300,000 for himself. So of this remaining amount, of this remaining 650,000, 300,000 would be given to the 4th child, and the remaining can be distributed as per his will. So the first heirship entitles the 4th child to receive $300,000. In this case, there is sufficient estate otherwise so as to be able to meet his claim. If there wasn't sufficient estate, then regulations allowed the 4th child to claw back this gift from each of the other children and receive his payout. Now, very importantly, the human capital is defined as the present value of net employment income expected over lifetime. The total capital can be calculated as the human capital, that is this present value, plus the financial and other assets. These are generally savings that have happened in the past. So my total capital at any point in time is the savings that I have done plus the present value of the future income that I'm expected to receive. Total liabilities are the present value of the cost of living, any planned bequests that I want to do to my children or anybody else, mortgage payments, etc. So total liability is essentially the present value of all my expected liabilities in the future. Core capital is defined as the total liabilities, that is these, plus a reserve for unexpected needs if mentioned in the question. If there's no reserve or no such need mentioned, then the core capital will simply be the total liabilities or the present value of all future expected liabilities. The excess capital is defined as the total assets minus the core capital. That is the human plus financial capital to whatever extent it is above my total liabilities plus a reserve for unexpected needs would be the excess capital. Now the core capital and excess capital can generally be determined with the help of a mortality table as shown. So the first column refers to the expected number of years of future life. So for the next 1 year or after the next 1 year, the age of the husband would be 75. The probability that the husband would survive for the next 1 year is 88.55%. The age of the wife would be 72, and the probability that she will survive for 1 more year is 97.11%. Combined probability is the probability that either one will survive. So if we say that A is the probability of the husband surviving, B is the probability of the wife surviving, then the probability of either A or B, that is either the husband or the wife surviving, can be represented as the probability of A plus the probability of B minus the probability of A intersection B. You can please verify from this calculation that the combined probability of either one of them surviving will come out to be 99.67%, that is 0.8855 plus 0.9711 minus the product of the two. The real annual spending is the expected spending if either one of the husband or the wife survives. So if either one of them survive, this is the amount that they'll have to spend annually. The expected real spending hence can be calculated as the real spending multiplied by the probability that either one of them will be alive. So this multiplied by the combined probability, or the real spending multiplied by the combined probability, will give us the expected real spending, that is about $174,000. This is happening 1 year later, or this is the amount that needs to be spent 1 year later. So the present value can be calculated by discounting it back by 1 year, and this will be our core capital, or the present value, or the expected present value of our liabilities for the next 1 year. If they're expected to live for the next 2 years, the husband's age would be 76. The cumulative probability that the husband would live for 2 more years is 87%. The probability that the wife would live for 2 more years is 95%. The combined probability that either one of them will live for the next 2 years is 99.39%. The real annual spending is expected to grow at some rate, and we can multiply this with the probability to compute the expected real spending for the second year. We can similarly compute the present value of the spending. So we'll discount this back 2 years because the spending is expected to happen at the end of the second year. And if we take a cumulative sum of the first calculation and the second calculation, this will be the core capital for the next 2 years. That is the present value, or the expected present value of our liabilities for the next 2 years is this much. Similarly, we can compute the core capital for the family living 3 more years, 4 more years, 10 more years, 11 more years, so on and so forth. We will compute the present value of the spending and keep summing it up. The cumulative level, the cumulative present value that is in the last column tells us the core capital for the next 8 years. Similarly, the core capital for the next 10 years. So once again, the combined probability is the joint probability that either one will live to a given age. The real annual spending is the estimated spending for the year in US dollars. Annual living expenses are expected to increase at a real growth rate of 3%. Expected real spending is the real annual spending multiplied by the combined probability. The present value is the expected real spending discounted to year 0 at the real risk-free rate of 3%. Please note, since it's a real spending, it has to be discounted back also by the real rate. If it was a nominal spending, it would be discounted back by the nominal rate. Total is a running total. It's the amount of core capital required to meet living expenses through the given year. For example, assuming no further contributions, it will take a portfolio of $1,986 today to meet the expected expenses for the next 6 years. We can check that from the mortality table. So 1,986 is the core capital needed for the next 6 years, and we understood how the calculation is derived. Using the mortality table, determine the probability that either the husband, the wife, or both will be alive in 8 years. So let's go back to the table, and we can see for the 8th year, we can simply look at the combined probability and conclude that there's a 90.6% chance, or we could have calculated as the probability of A plus the probability of B minus the probability of A into B. That you can verify will also give us 90.6%, or the probability that either one of them will be alive after 8 years. Based on expenditures in the table, calculate the core capital required for the next 8 years. And if the family has a portfolio of $2 million, determine the maximum amount they could give to charity, assuming an 8-year planning horizon. So the core capital, as we discussed, is the last column, and we can see that for 8 years we need a total amount of $1.313 million so as to be able to meet all our expected liabilities in the future, or this is the present value of the expected liabilities in the future. If currently we have a portfolio of $2 million, and assuming we only want to fund our retirement or our expected expenses for the next 8 years, we're not worried about the years later on. Probably the government will take care, or something has been thought of. So with an 8-year planning horizon, the maximum amount I can give to charity today, assuming I'm not keeping any reserve for unexpected circumstances, would be 2 minus 1.313, or approximately $0.7 million, because this is the total capital or the present value of my assets. This is the present value of my expected liabilities. However, this does, or doing this, giving away so much to charity, will put us at risk, because if we do survive to that extent, then we may run out of money. This is also referred to as longevity risk. So 90.6%, the core capital, we can see the detailed calculation. The discounted back value is $1.313 million, and the excess capital, that is amount above the core capital, comes out to be approximately $700,000, which they could give to charity. Very importantly, a safety reserve must be incorporated into the excess capital computation for at least 2 reasons. First, mortality tables are derived from the average population. So there is always some probability that a particular individual may live beyond the planning horizon. So if the life expectancy is 80 years, for instance, then that means roughly half the population lives less than 80 years and half the population lives more than 80 years. That's why the expected value has come out to be 80 years. So if you do your planning only by the expected life horizon or expected time horizon, then you run longevity risk, or you run the risk that you may live. There's a 50% chance essentially that you will live more than 80 years. Hence, you need to build a safety return to account for the fact that you may live beyond the expected lifespan of a normal human being. The portfolio is expected to grow at the real risk-free rate, whereas returns in some periods may also be negative. That is, the portfolio may fall short of the required amount at maturity. So we've computed the present value of liabilities, and we say that if the present value of assets is the same as the present value of liabilities, then we are good. But this inherently assumes that as liabilities grow by the real risk-free rate, or whatever is the discount rate that we've used for the liabilities will grow at that rate. Our assets will also grow at the same rate. While this may be a fair assumption, we do have to account for the fact that if we make some bad investments, these assets may or may not exactly grow by the real risk-free rate, and if returns are negative in particular years, then again we may fall short of our liabilities as they become due. So for both these reasons, we must build a safety reserve in our calculation of the excess capital, and we should keep some amount in excess to account for these eventualities. A Monte Carlo simulation may be able to better incorporate distributions of inflation rates, asset class returns, tax rates, lifespans, etc. And an analyst will be able to better calculate the longevity risk and the probability of ruin. So probability of ruin is the probability of running out of assets before the person's death. So like always, the Monte Carlo simulation has advantages in that various distributions and various assumptions can be inputted. But again, that is also the disadvantage, that in case we misestimate or wrongly enter any of these inputs, then our output will also be flawed. So please understand, the probability of ruin is the probability of running out of your assets before your death. Generally, if the retirement age is higher, the probability of ruin tends to be lower. If retirement age is lower, then the probability of ruin tends to be higher. If the median age at death is lower, or rather the assumption of the median age at death is lower, then the probability of ruin would be lower. If the assumption for the median age at death is higher, then the probability of death will be higher. If the spending rate is low, the probability of ruin again would be lower. If the spending rate is higher, then the probability of ruin would be higher. So what we can generally say is that when we are planning the estate for our client, we should ensure that we keep sufficient reserves and sufficient assets for him, and then decide to transfer other assets to trusts and to other instruments to transfer them to his beneficiaries or to other people that the testator wants. So we must understand his requirements, his core capital, and what are the assets that he needs for himself to meet his living requirements in the future. Applying a Monte Carlo simulation in that process may be helpful. So once we've understood the client's core capital and the excess capital that he has, we can start about the process of transferring his assets and see what would be the best method and see the relative after-tax values of the various strategies that he can apply. So for example, a donor is expected to live another 10 years, over which time his stock is expected to earn 9% per year. Both the donor and the recipient pay investment return taxes of 25%. Inheritance takes 35% of testator's estate, inheritance taxes that is. Determine whether the individual should gift the stock immediately, which in this case is tax-free, or leave it to the beneficiary in a will. Also calculate the relative value of a tax-free gift. So let's assume that he had $1 to donate, and in one case he transfers it today, which is tax-free, the gift is tax-free, or he leaves it as a bequest. What would be the value of that $1 in the hands of the testator n years later, that is 10 years later? So we can derive a general formula. If he had $1 and if we were giving it as a tax-free gift, then the $1 would be gifted today itself. It would grow at the rate of 9%, that is the expected return in the recipient's portfolio. In our case, it's the same. We can generally write this will be 1 plus RG, and both donor and recipient pay investment return taxes of 25%. So of this return, 25% would be taken away as taxes. So TIG is the recipient's tax rate on investment income. So into 1 minus TIG is what it would become at the end of the first year. These proportions would continue for the next n years and this is what the value would be if I gift the asset today itself. So this is what the asset will be as a tax-free gift today. If I leave the $1 at bequest or after death, then today they will earn a return in my account, that is the expected return in the donor's portfolio. So it will be 1 plus RE. I pay taxes every year at the rate of the donor's tax rate on investment income, that is TIE. So into 1 minus TIE. So this is what will continue to happen for the next n years, after which I die and the estate gets transferred to the beneficiary or the recipient, who will then pay inheritance taxes, that is TE. So into 1 minus TE. So this calculation or this ratio would be the relative value of a tax-free gift as against a inheritance or a bequest. So depending on the various rates that will be given in the question, we can calculate what is beneficial or not. So the return in this case is given to be 9% and the taxes are given to be 25% for the next 10 years, divided by 1 plus the rate remains the same in the donor's account. Taxation also remains the same. However, there will be a further inheritance tax of 35% that will have to be levied, or the relative after tax value would be 1 upon 0.65, that is equal to 1.53 as a tax-free gift as compared to a taxable inheritance. So in this case, it is better to leave or transfer it as a gift today itself. You will be able to transfer more than if you wait till your death and transfer it as an inheritance. Now if it is a taxable gift, the calculation will change slightly. So a donor is expected to live another 10 years, over which time his stock is expected to earn 9% per year. Both the donor and the recipient pay investment return taxes of 25%. Inheritance taxes take 35% of a testator's estate. Gift taxes equal 20%. Determine whether the individual should gift the stock immediately. It is not tax free now. There is a gift tax of 20%, or leave it to the beneficiary in a will. Also calculate the relative value of a taxable gift. So the only change that will happen in the calculation is that the $1 when we transfer it today will not be tax free. It will become 1 minus the gift tax rate, and subsequently the calculation remains the same. It will earn a return in the recipient's accounts. It will be taxed at the recipient's tax rate, income tax rate, or the investment income tax rate, and it will grow for the next n years. In the hands of the testator, it will grow at whatever is the donor's return into 1 minus the tax on investment income in the hands of the donor to the power n. However, when you transfer it as a bequest, you'll have to further pay estate taxes, and this will be the final value. So once again, all values are given. Since gift tax we see is lower than estate tax, again gifting will be better. So the relative value would be 0.8 into 1 plus 0.09 into 0.75 to the power 10 divided by 1 plus 0.09 into 0.75 to the power 10 multiplied by 0.65. So this will get cancelled. It will be 0.8 8 divided by 0.65, that is equal to 1.23. So it's still 1.23 times better to gift it, because the gift tax rate is lower than the inheritance tax. So pretty straight up calculations, these generally should not be a problem. Just one calculation that we cannot prove and we need to memorize is when gift taxes are paid by the donor. So please note that if the donor himself is allowed to pay the gift taxes, then the relative value of a taxable gift will be slightly higher. That is, the formula remains the same. It will be PV into 1 minus TG. However, there will be one addition of TG into TE, where TG is the gift tax rate and TE is the estate tax rate to the overall formula. Rest of it remains the same. So please note, this is one formula that we are unable to prove at the moment, and you just need to memorize this for the exam. Not very likely that this will be tested, but please note, if gift taxes are paid by the donor, then when you do 1 minus TG, that is on the gift, just add TG into TE if gift taxes are allowed to be paid by the donor. So if all rates are given to us, 9%, 25%, the gift tax rate, the estate tax rate is the same, we can substitute in the formula and calculate. This comes out to be 1.34 times. So a taxable gift at a rate of 20% tax rate, with gift taxes being allowed to be paid by the donor, will be better than an inheritance by 1.34 times. The relative value will be higher to the extent of 1.34 times as compared to an inheritance. Now there are various estate planning strategies that can be employed so as to reduce the tax outgo and provide other benefits to your client. Generation skipping is one such strategy. So assume an expected after-tax return of 6% on assets that will ultimately be transferred to the third generation from the second generation. So you have earned something. When you transfer it to your children, you're sure that even your children have enough assets for themselves that they will not eventually be using these assets, and most likely these assets will be transferred to the third generation. Right now, if you transfer it to your children and then they transfer it to their children, there is essentially two layers of taxation that is happening. So what generation skipping allows you to do is to directly gift the assets by means of some structures or some trusts to the second generation, such that two layers of taxes don't need to be paid. There's just one inheritance tax or gift tax, whatever it may be, that needs to be levied. Assume that the first generation will transfer the assets to the second generation in 10 years, and the second generation will transfer the assets 20 years after that to the third generation. Also assume equal gift and inheritance tax rates of 40%. So whether you gift it or you leave it as bequest doesn't matter. Calculate the value to the second generation after 30 years. Also calculate the relative value of generation skipping. So once again, if we assume we have $1 to gift or leave as a bequest, if we gift it directly to the second generation, then there will be one level of inheritance tax, or rather one level of gift tax, after which the asset will earn a return and we'll pay a tax on it for the next n years. In this case, for the next 30 years, or this will be the value after 30 years. As against, if the first generation transfers the assets to the second generation after 10 years. So they gift it now and the second generation keeps it for 10 years, or they wait for the next 10 years and then transfer the assets. There will be first leg of inheritance tax or gift tax, which are assumed to be the same. The assets will then grow for another 20 years at the same rate and at the same investment income tax, after which they'll be transferred to the third generation, and when this transfer is executed, there will again be another layer of inheritance taxes that will have to be paid. So the investment return and the investment taxes essentially cancel each other out. Since the gift tax and the estate tax are also given to be the same, the relative value of generation skipping can be derived as 1 upon 1 minus the inheritance tax rate or the gift tax rate, or 1 upon 1 minus 0.4, that is 1 upon 0.6 or 1.666, which comes simply as you're avoiding 2 layers of tax. So it's that one layer of inheritance tax that you're saving that is giving you that relative value or relative advantage of generation skipping. Similarly, there could be generation skipping directly to the 4th generation or the 5th generation also, if you thought that the generations in the middle would not need the assets. So you could set up structures that directly transfer assets to further generations and hence save on taxation. Other estate planning options that are generally available and that you should generally be aware of is spousal exemptions. So many countries allow tax-free transfers of estates between spouses. So if one spouse passes away, the other spouse will receive the estate without paying any tax. There are also valuation discounts that can be applied and that will help reduce your tax outgo. So ownerships in partnership structures and other private companies cannot easily be valued since there is no listed market price. And hence, when you're transferring these assets, various discounts for the lack of liquidity, discounts for the lack of control, as we studied at level 2, may be applied to reduce the value of the transferred assets and hence the associated taxes. If the testator has some will of leaving something to a charity, then these charitable gifts should be made sooner rather than later, as we will see, because these gifts are not taxed, and normally the owner can further claim a tax deduction on his or her personal income. Charitable organizations are further tax-free, hence these gifts can further grow tax-free. So what we'll prove very soon is that if you, let's say, wanted to leave $1 million in charity after 10 years, it's better to give $100,000 today itself, because this $100,000 becoming 1 million would be much easier in the hands of the charity than if you do it in your own account, wherein you won't get any benefits and you'll have to pay additional tax. Determine the relative value of leaving assets to a charitable organization as opposed to bequeathing them to beneficiaries. RG is the expected return on the assets in the charity's portfolio. TOI is the tax on ordinary income. RE is the expected return on the assets in the donor's portfolio. TIE is the donor's tax rate on investment income. And TE is the estate tax rate. So if we give $1 to charity, then first of all, on that $1 we will not have to pay any tax. Then the $1 will grow at an expected return of RG in the charity's portfolio, where there will be no investment income tax. So it can continue to grow for the next N years. And N years later, there is no estate tax or gift tax that needs to be paid. Furthermore, this $1 can be used as an expense directly in your taxable income. So whatever is your taxable income will get reduced to the extent of this $1, and hence whatever is your ordinary income tax rate is the additional benefit you will receive on this $1 if you give it as charity. This is additional income or saving in tax happening in your account, which can get invested and will earn a return of RG. We will pay a tax of 1 minus the ordinary income tax on this income, and this will also compound for the next n years, after which we can bequeath it to our beneficiaries after paying the estate tax of TE. So $1 given to charity not only gives the benefit in the charity or grows tax free, but it also reduces your taxable income today and gives you additional benefit today, which will also compound in the future. As against bequeathing $1, wherein the returns will be taxed every year and then accrue or then compound for the next n years, and once you give them up or once you give them to charity or rather bequeath them to your beneficiaries, there will further be an estate tax of TE to be paid. So this will be the relative value of a charity, or this will be the relative value of $1 given to charity as against $1 bequeathed n years later. Please verify. We assumed RG and RE to be the same. You can assume different rates of growth in the charity and in your portfolio, and you will derive the exact same equation or the relative value. Now, if the rates are given, RG and RE are the same as 9%, tax on ordinary income is 45%, tax on investment income is 25%, estate taxes are 40%, and N is 10 years, and we can substitute all these values in the formula, and we can compute that the relative value of a charitable donation comes out to be 2.5 times that of $1 left as a bequest. We can also at times help our clients set up trusts. So trusts are means by which a grantor can transfer assets outside of the probate process. The trustee manages a trust in the best interests of the beneficiaries according to the trust documents. So we studied in the beginning that probate is the legal process that begins after your death, wherein generally the assets are disseminated according to your will or other legal procedures. We know this is a public process and it can be time consuming. Hence, at times you want to transfer assets outside the probate process, you can set up trusts that will help you do it. A revocable trust can be cancelled by the testator or the settlor. So settlor is still the legal owner of all assets and it can be revoked or he can cancel it. In an irrevocable trust, the settlor relinquishes control and the trustee becomes the legal owner. Claims against the settlor cannot fall on the trust assets. So these assets will be assumed to have been given to somebody else and they are now the property of somebody else. It will be assumed that the settlor or the testator has donated or given the assets to somebody else. They now belong to somebody else. If in the future there is a lawsuit or there is some claim against the settlor, then the claim cannot fall onto these assets because these assets belong to somebody else. They have already been transferred to that person. In a fixed trust, the distributions have been predetermined by the settlor. In a discretionary trust, the trustee determines the distribution or the distributions will be managed for the best interests or for the needs of the beneficiary. A spendthrift trust is set up when a beneficiary is too young and the owner still maintains some control over the assets and the distribution. So depending on the needs of the clients, you may recommend setting up one trust or the other in order to transfer the assets to the beneficiaries or outside of the probate process. You can also purchase life insurance, or if he wants to transfer assets after his death, he can purchase life insurance with the beneficiary as the nominee, and the assets transferred would be the premiums. That is, the life insurance can also be structured as a trust, wherein the premiums are transferred by the settler or the testator every period, and the benefits would be given to the beneficiary who can be the nominee of the life insurance policy. Claims are normally tax exempt, and life insurance thus represents a fairly efficient way of transferring one's wealth. As we discussed, life insurance can also be formed as a trust, or a trust can be the owner of the life insurance policy, and the claims will be given to the beneficiary upon death. Now, various tax regulations and tax jurisdictions exist across the world. So for income taxes, in source jurisdiction implies that all income generated in your country by anyone will be taxed. So source jurisdiction in income taxes means all income in your country is taxed. Residence jurisdiction implies that all income generated by your citizens will be taxed, whether in your country or abroad. You tax all income generated by your citizens. Similarly, wealth transfer taxes, source jurisdiction implies that all asset transfers within your country will be taxed according to the wealth transfer rules. Residence tax on wealth transfer implies that all transfers by your citizens will be taxed regardless of the worldwide location of the asset or of your citizen. Sometimes countries impose exit taxes. These are taxes imposed on assets leaving a country. So if you're repatriating money or repatriating assets, then at times you have to pay some amount of money to the government before you can take that asset out of the country. Now, there can be various conflicts that may lead to double taxation of an individual and may require a special resolution. In a residence conflict, two countries claim residence for the same individual and are hence fighting over it. In a source conflict, two countries are claiming authority over the source of the same income and hence there is a conflict. So one country is saying it was earned within my boundaries, another says it was earned in my boundaries, and hence both want tax. Similarly, two countries claim that the same individual is a citizen of one country and hence they want tax, and both of them have a residence tax policy. So a resolution of such conflicts is generally an international tribunal or some recourse to an international court that will decide the residence or that will decide the source of the income. The residence source conflict comes when the individual might be a citizen subject to residence jurisdiction and working in a country with source jurisdiction. So he is a resident of a country, or he's a citizen of a country that has residence jurisdiction, so his income has to be taxed. And he is working in a country with source jurisdiction, so again his income has to be taxed, again amounting to double taxation. Now there are various resolutions for the third conflict or the recent conflict that we mentioned. In the credit method, the residence country allows tax credit for taxes paid to the source country. So the residence country gives in and it says that, okay, to whatever extent you have paid taxes to the source country, you don't have to again pay me taxes. So what this eventually amounts to is that the tax rate paid is the greater of the two. For instance, if the residence tax rate is 30% and the source tax rate is 40%, then anyways the residence or the country will not charge any tax because you've paid 40%. If it's the other way around, the residence tax is 40 and the source tax is 30%, then you've already paid 30% of the source country Your residence tax is 40, additional 10% you will pay to the residence country. So in the credit method, the tax rate paid eventually works out to be the greater of the two. In the exemption method, the country of residence simply charges no tax. So your tax rate is essentially that of the source country, or that is the tax that you will pay. In the deduction method, this is only a partial resolution. You first pay full tax to the source country, and then you are allowed to deduct the tax paid in calculating your worldwide income for the residence country. So let's say $100 was your income, and $20 tax you have already paid to the source country. So what the residence country says is that you can treat this as an expense. So whatever tax you have already paid to the source country can be used to will be deducted from your taxable income. You will still have to pay tax on the remaining amount to the residence country. So this will still amount to some degree of double taxation, because the relief is only partial. You're only allowing the tax to be reduced as an expense. You're not giving him full relief from double taxation. For example, an individual living in a country that bases income on residency or income tax on residency has total worldwide income of $1.3 million. 0.5 million of that amount is generated in a source jurisdiction country. The domestic country charges 35% income taxes on worldwide income, and the source country charges 30% taxes on income generated within its borders. Determine the income taxes paid on the foreign source income and the amount received by each country under the credit method. So in the credit method, as we studied, the residence country will charge tax only if there is anything pending after the source tax. So the source country charges 30%. So 30% of 500,000 or of $0.5 million would have already have been paid to the source jurisdiction. On the remaining income, that is 0.8, the individual will pay 35% tax to the residence country, and on this 0.5 million, he has already paid a tax return of 30%. So he has to only pay 5% additional tax that he hasn't yet paid, or that's what the credit method allows him to do if he is a citizen of a country of residence taxation. So another 5% of 0.5 million he will have to pay. You can verify that what this will effectively do is that his entire income of 1.3 million is being taxed at the rate of 35%, or the sum of these two taxes would equal 1.3 million into 0.35. So the tax rate in the credit method eventually turns out to be the higher of the two tax rates, that is the source or the residence. Under the exemption method, the residence country will simply charge no tax on this 0.5 million that has already been taxed in the source jurisdiction. So on the 0.8 million, he will pay 35% of tax to the residence country, and on the 0.5 million, he will just pay 30% of tax to the source country. There will be no further taxation. So this will be better in this case than the credit method that we saw earlier. In the deduction method, please note it's only a partial resolution. So what the residence country says is that whatever taxes you have paid to the source jurisdiction, you can claim them as an expense, or you can use them to reduce your taxable income. So on 0.5 million, we've already paid 0.15 million as tax. So $0.15 million will be reduced from our taxable income, which will now become $1.15 million. And on this, we will still have to pay 35% tax. So the highest tax outgo will be in this regards, where only a partial reprieve to the extent of 30% of this income is being given. 70% of this income is still being double taxed. So that 0.5 is fully taxed in the source, and then 70% of this 0.5 is then again being taxed in the residence country. Only to the extent of the tax that we have already paid, we are getting some benefit. So please verify. As regards international transparency in taxation, tax avoidance, that is minimizing taxes through legal tax reduction strategies, is legal. Tax evasion, that is hiding, misrepresenting or not recognizing income, is not. So you can help your clients with tax avoidance, and to that extent that is your fiduciary responsibility, but not with tax evasion. Most countries are increasingly sharing data to avoid and to reduce tax evasion. So that was about the review on estate planning. We'll study more concepts related to private wealth management in the coming sessions. So thanks a lot and see you next time.